right, Justin, we're back for another AWM Insights here. Excited.
Here we are.
Yeah, excited to get going. At the top here, let's just mention that phone number again. Hopefully people can shoot us a text. Beginning of the year, we'd love to hear from people. Just, are we hitting on the topics that they want to hit on, all that good stuff. So 602-704-5574. You can shoot me a text. Questions, comments, etc. We're open to all of it. We had a big event, or at least big event in our world, the anniversary of the ETF, right? So,
let's bust out the champagne.
Yeah, let's bust out the champagne. In all seriousness, it has been a great thing for investors. I think we believe that at least. And
for sure.
So we'd like to talk about that a little bit today. But before we get into some of that stuff, I mean, there is a lot going on out there right now. If you're paying attention, even not the financial news, but just the news in general. If you've been on Twitter at all, you're seeing that there's just layoffs abound. And it's really hitting the tech sector and the banking sector a lot. So we're getting questions, how's this impacting the portfolio? How are we thinking about that in investment implementation, et cetera? So thought it'd be fun to just chat about that a little bit today and try to, demyth or at least talk a little bit about why some of these companies might be laying off. And is it a horrible thing? Is it, just part of normal business practice? Probably a mix of both.
Yeah, totally a mix of both. And I think it's also important to underscore that in general, the labor market seems to still be relatively healthy. The unemployment reports that came out recently still show a growing workforce overall. That's, I will admit, a lagging statistic, meaning it's looking back in time as opposed to looking forward. And these headlines that we're seeing are a lot forward-looking or real time, really. But to your point, they're isolated right now in two main industries. And really specifically one, tech, that is. You mentioned it. There's a decent number of layoffs that are happening within the big banks of the world. But the thing to keep in mind with these is, A, it is normal. It is part of a cycle. It is hard to see people lose their jobs. Let's not necessarily take the entire human element out of it, but we are talking about investing in finance and whatnot. And to an extent, we have to look at things at a real high level. And there's actually a good benefit from people being laid off within tech. And I'll try and make sure I remember to mention that. But I mean, what happened here? The last 3-4 years, let's just call it the pandemic era, these tech companies went on an insane hiring frenzy.
Yeah.
Microsoft grew by 53%, their workforce, that is. Alphabet, the parent company of Google, 57%. Amazon, Meta, parent company of Facebook, their workforce is nearly doubled. I mean, there's this insane amount of hiring that was going on in that period of time within tech specifically. And there was the belief, the reason why this hiring was going on was the belief that all these dynamics and characteristics of the economy that were happening during the pandemic, that they were going to continue on forever. And fast forward to today, we know that they're not. And there's definitely some nuance to that, right? Meta invested heavily in the metaverse. That's why they changed their name way back when, and they're pumping the brakes on that a little bit. So there's broad macro trends going on here where they're like, whoa, we may have got ahead of ourselves. Let's take our foot off the gas a little bit. And then there's some sub trends here too, like Amazon is a great one, right? People are actually leaving their house to go shopping nowadays. People are not spending as much time in the metaverse as Facebook or Meta would have liked. And then on the finance side of things, I think there's some similar dynamics where they see a slowing sector overall. Interest rates are a little bit higher. The economy potentially is slowing, although the tone has drastically changed on that looking forward, which is a great thing. But banks are being cautious and saying, hey, let's reduce our costs, let's reduce our headcounts. The positive, and I'll stop after this, is within tech, you have these brilliant minds, these engineers who are now free, if you will, and in some cases forced to go figure out something else, which is wonderful for, say, the venture capital startup ecosystem, where you have these brilliant minds now either starting companies, or it's talent that is available to existing companies that might be smaller and maybe have different pay packages or the ability to pay people in the same way that, Microsoft Google, et ceteras of the world could pay. And so that's a great talent pool that can now be really dynamic and creative and ideally grow new companies out of this.
Yeah, I think that's a good point. I think it's a good reminder too that, this is just, I hate to say it, but a sort of a normal business cycle type thing, right? And it's healthy. It's like we talk about markets. If markets just went up,
Totally.
in the face of bad news or changing circumstances, we naturally go to hey, things are broken. The market's broken. That's not a good thing, right? And so you want to feel the adjustments that go on. I think, with the tech sector, Microsoft's a great example. They're laying off a ton of people, but at the same time, they're turning around and buying OpenAI and Chat GPT for $10 billion. So like they're just reshifting their business priorities, right? And so they're looking ahead to what the future is. Or you look at like a Goldman laid off, a little over 3,000 people. They looked at their business and said, the consumer banking division is hemorrhaging money.
Right.
This isn't where we want to put our capital. We want to go back and reinvest in the investment banking sector where we're an investment bank. That's at the heart of what they are. So you start to see this shift in priorities a little bit, and it just refines the business, right? And I think that's certainly a big positive that can come out of all of this. And these companies need to adjust. They adjusted, with big growth expectations, and now they got to trim it back. And so how it relates, I think, tying it really quickly back to the portfolio and how we invest your money is these things aren't predictable.
Totally.
And
even these big companies can't predict the future.
Exactly.
Perfectly.
It's very difficult for them to predict. And, in the short term, there might be some pain. Maybe there won't. Maybe to your point, like all these guys and gals will roll out of these companies and start wonderful companies in the short term. But at the end of the day, we don't know what the near future is going to hold. And so even in the midst of potentially bad news of layoffs or corporate restructurings, this is why we build your protective reserve. This is why we have this cushion sitting there so your life doesn't change. And we focus on, your priorities and tie everything back to what you're trying to accomplish and get really granular with that so that, if the world does blow up, say this does turn worse and even more people get laid off, you've got a buffer to work your way through that. Or short term, hey, positives come out of this. Great. You're going to benefit from that because we have your allocation in a proper way.
And I think it's a great argument for diversification too.
Totally.
Which the ETF provides.
Good segue.
Perfect. I know, man. You set me up there. That is essentially the ETF's duty purpose. It's not the only vehicle that does it, but it's an incredibly efficient vehicle in getting diversification and broad access to various asset classes. But, you said at the outset, it's the 30-year anniversary of the ETF, the first ETF, an ETF, let's define it, I suppose, exchange traded fund. It's similar to a mutual fund. I think a lot of people are still to this day more familiar with mutual funds, although ETFs are fast catching up. It is the 30-year anniversary of the ETF. Mutual funds have been around since, I think the 30s, maybe 40s. I don't know the exact date. So they've been around for a lot longer, but similar principle. You're pooling investors' capital together to get broad diversification. And not only is diversification an incredible benefit for the examples we just highlighted, but you also get the benefit of shared costs and economies of scale, if you will. So as opposed to just going and investing in a single stock by yourself, which is now arguably very cheap because of technology, you're getting even better access, arguably, to a larger swath of shares of companies through a vehicle like an ETF. And it's phenomenally beneficial to the end investor.
Yeah, I think that's a good note that at the end of the day, I think you can simply think about this as it's structure, right? And that's all an ETF is. I think in the early days, the ETF was very synonymous with passive investing. I'm going to hold the market, et cetera. And that really over the last, 5-10 years is completely blown up. Right. So now an ETF, you could be actively traded. You could basically
leverage.
You can do anything. So I think for those clients listening, that's one thing to remember is, an ETF can now be pretty broad. A mutual fund can be very broad. And, I don't want to say they're quite interchangeable, and we're not going to get in the weeds here. But at the end of the day, you're not just investing in the investment isn't the ETF, right? It's what the ETF holds is what you're investing in. But very tax efficient typically can be, but not always low cost anymore, but typically can be very low cost and should be for clients listening. All of your ETFs are very low cost and and very tax efficient as well. So, I think those are some things that historically got really, synonymous with the ETF, but no longer is the case. So it's become more complicated, I guess, in a lot of ways, but a fantastic structure to build out a public portfolio.
Oh yeah. Still the tool set, if you will, or toolkit of ETFs is wider than it ever has been, but they are still phenomenal vehicles to implement an incredibly efficient portfolio, efficient from a cost perspective, trading perspective, all of that stuff. So you don't have all these needless frictional costs, or you're minimizing them as much as possible. It is really, we say taxes generally can be the number one destroyer of wealth, and an ETF is one of the most efficient vehicles to minimize taxes. When we talk about costs, we're not only talking about the management fees to actually operate it, but like you said, they're also efficient from a tax perspective, and you can really benefit from that long-term compounding of wealth by leveraging the right ETFs. They're not all created equal, but they are incredible vehicles, and we've all been the benefactor of them. So yeah.
Awesome. Well, cool. Well, we'll wrap up for today. I'm going to remind you guys again of this number, but 602-704-5574. Shoot us a text. We'd love to hear from you. Hopefully this was helpful. Hopefully we didn't get too nerdy on the ETF, but yeah, let's adjourn for the day. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.